In the flicker of candlelight in 17th-century Amsterdam, a daring merchant dared to unite capital and trade across continents. He imagined a market where wealth could be sliced into shares and sold to distant investors. This was no small dream. It would birth the first truly global stock market. If you care about the origin of the financial world you live in, stay with us. Like and subscribe for more journeys into finance's hidden origins. Across oceans and empires, trade was the artery of wealth. But where merchants once hoarded treasures in chests, this merchant would turn those treasures into tradable equity. This story traces that transformation. We'll explore how a visionary merchant, backed by state power and colonial ambition, forged the first global capital market, and how his legacy haunts today's financial systems. What does it mean to create a global stock market? It means enabling ownership claims that transcend local borders, enabling remote investors to partake in faraway ventures. It means transforming risk, trust, information, and credit. And it means giving birth to a new class, the public shareholder. Our narrative centers on that first merchant, walking the narrow streets of Amsterdam, hearing ship horns from Batavia, and feeling the heartbeat of capital. Before we dive into that merchant's life, we must understand the soil he walked upon. Europe's medieval and Renaissance merchant republics had already laid foundations: bankers in Venice, moneylenders in Bruges and Antwerp trading bills and bonds. But these were debt instruments, not equity. The leap from debt to shares, from opacity to public markets, would demand a singular ignition. In Antwerp in the 1530s, dealers traded promissory notes and bills of exchange, early seeds of market trading. In Italy and the Hanseatic cities, merchants pooled resources for voyages, but with fragile contracts. The idea of buying shares in a commercial venture existed in sketch, but lacked formal institutional structure. The merchant we follow saw that gap and began engineering a system. That merchant lived in an age of Dutch maritime ascendancy. The Netherlands in the early 1600s was a nexus of trade: spices, textiles, colonies, shipping. Dutch merchants were bold, their chartered companies powerful. Among them, the Verenigd Oostindische Company, the Dutch East India Company (VOC), would be his stage. The VOC is often called the first publicly traded company. In March 1602, the States General of the Dutch Republic granted the VOC a charter, giving it monopoly rights over trade in Asia and permission to issue shares. Investors across the Dutch Republic could subscribe. This was an audacious model: communal capital funding distant empires. The merchant at the center of this was not a single individual in some records, but rather the class of VOC merchants, governors, and financiers acting as one. From this moment, the merchant class began packaging voyages as securities. One could invest in a fleet, a voyage, or trade stock in a company. The merchant's daring was to standardize shares, define transferability, and create a market in Amsterdam. Shares could now trade independently of the voyages themselves. The merchant had invented liquidity in enterprise. By August 1602, the VOC offered its first IPO, a public subscription of shares. That was the first time in history that shares in a broad enterprise were sold to the public. The architectural groundwork of a stock market was laid: capital raising, share issuance, and open transfer. The merchant's courage transformed capital from static treasure to dynamic equity. Early trading after the IPO happened in informal networks in Amsterdam, at commodities houses, corners, cafes, and spots near Dam Square. Soon, formal exchange houses emerged. In 1611, the Hendrik de Keyser Exchange Building opened, with traders negotiating share transfers. The merchant, walking through its halls, witnessed a new kind of market pulsating with bids and offers. Within years, the Amsterdam market had become not just local but international. Merchants from Hamburg, London, and Lisbon sent capital to Amsterdam. Dutch investors placed bets on Asian voyages. The merchant had created a node of global capital flow. Price discovery, speculation, and arbitrage emerged. The first global stock market was alive. Into this ferment walked Joseph de la Vega, a Sephardic Jewish merchant and thinker, who experienced daily the chaos and wonder of this new market. His 1688 work Confusion of Confusions is the earliest attempt to describe the psychology, mechanics, and dangers of stock trading. He studied this merchant world from inside, not as distant observer, but as participant. De la Vega's dialogues reveal how merchants, speculators, and philosophers wrestled with uncertainty. He names bulls and bears, manipulation, rumors, margin, options, and the herding patterns of investors. Through him, we glimpse the emotional and structural architecture built by that first merchant class. Over decades, merchants refined rules, share ledgers, notarial offices to record transfers, contract enforcement, disclosure norms though imperfect, and standardization in trading sessions. The merchant's ambition was institutional. He didn't just trade, he built mechanisms. He made governance, legal form, and reputational systems part of finance. But this first global market was not without crisis. Speculation could run wild, manipulation, insider knowledge, rumors, and panic circulated. De la Vega laments how greed, deception, and fear twist even the most rational investors. The merchant's market was fragile. Every bubble, collapse, or panic tested the system. Across Europe, the example spread. London brokers meeting in Jonathan's coffee house began posting stock and commodity lists. By 1698, John Castang was publishing price lists of stocks and commodities, an embryonic exchange in London. Merchants in England watched the Dutch system and adapted it. In time, the London model matured into the London Stock Exchange. In 1773, the brokers formally took over the coffeehouse space and institutionalized trading. Meanwhile, in the American colonies, merchants copied this model. The Philadelphia Stock Exchange in 1790 and the New York Stock Exchange via the Buttonwood Agreement in 1792. In New York in 1792, 24 merchants and brokers signed the Buttonwood Agreement under a sycamore tree on Wall Street to set rules for commission and orderly trading. Among these merchants was Ephraim Hart, who helped organize what became the New York Stock Exchange. That agreement echoes the audacity of the earlier Dutch merchants. Over time, that merchant lineage evolved. Stock exchanges rose in Paris, Frankfurt, Madrid, and beyond. Global capital flows multiplied, connecting London to Bombay, New York to Shanghai. What began as one merchant's dream became a lattice of global finance. But beneath the canopy of successes lay recurring dangers. Bubbles like the South Sea Bubble in 1720, the Mississippi Bubble in France, and later crashes tested the limits of merchant-engineered markets. The merchant system required constant adaptation, regulation, and moral restraint. The merchant's legacy also included the idea of limited liability, whereby an investor's loss is capped at their investment, a critical innovation to scale public participation. Without that, risk would deter broader investor classes. Many older chartered companies and partnerships lacked that feature. Our merchant insisted on it. Over the next centuries, merchant capitalists mutated into bankers, speculators, institutional funds, venture capitalists. The fabric that merchant wove was stretched and repurposed. Markets, derivatives, exchanges, index funds. But the echoes of the first global stock market linger. Because the merchant's market was global, capital and information flows crossed borders. That introduced currency risks, sovereign risk, colonial exploitation, and asymmetric information. The merchant could never control all variables, and sometimes suffered catastrophic failures. The emotional undercurrents, fear, greed, rumor, herd mentality, that de la Vega observed are still portraits of market cycles today. The merchant showed that markets are not just mechanical, but human. Understanding that was part of his groundbreaking insight. In modern times, we often celebrate exchanges like the NYSE or NASDAQ. But the real ancestor is Amsterdam's merchant-driven marketplace. The geographies change, but the DNA remains: liquidity, share tradability, speculation, information asymmetry. Through centuries of war, revolution, regulation, and crisis, the merchant's model adapted. Stock exchanges modernized, technology transformed them into electronic networks. Yet the foundational idea, that capital can be fractioned and traded globally, still comes from that merchant class's leap. Today, we stand on his shoulders. Global equity markets link Lagos to London, Shanghai to Sao Paulo. The possibility of cross-border investment, exchange-traded funds, remote shareholders, all derive from the merchant's original blueprint. But we must also heed his warnings. Bubbles, crashes, insider trading, and systemic risk are not aberrations, they are part of the system he built. Regulation, transparency, and ethics must walk beside innovation. So when you check your portfolio, or watch capital flow across continents, remember, it all began with a merchant, bold enough to turn voyages into tradable shares, capital into a living, breathing market. The first global stock market was his audacious offering to the world. The merchant who created the first global stock market did not do so for fame, he did it for capital, ambition, and vision. But his legacy is immortal. He gave us markets that cross oceans, that mobilize savings into enterprise, that expand prosperity and danger. The moral is clear: innovation demands vigilance. If you've enjoyed this journey into financial origins, like, subscribe, and dive deeper with us next time, where we trace the merchant's children, the modern markets that shape our world.